Hello everyone, today we're going to talk about risk management, immunization. So what is immunization? Immunization, also known as multi-period immunization, is a risk mitigation strategy that matches the duration of assets and liabilities in order to minimize the impact of interest rates on her worth over time. Understanding immunization. The immunization helps large firms and institutions protect their portfolios from exposure to interest rate fluctuations. Using a perfect immunization strategy, firms can nearly guarantee that movements in interest rates will have virtually no impact on the value of their portfolios. For example, large banks must protect their current net worth, whereas pension funds have the obligation of payments after a number of years. These institutions are both concerned about protecting the future value of their portfolios and must deal with uncertain future interest rates. Immunization is considered a quasi-active risk mitigation strategy because it has the characteristic of both active and passive strategies. By definition, pure immunization implies that the portfolio is invested for a defined return for a specific period of time, regardless of any outside influences such as changes in interest rates. The opportunity cost of using the immunization strategy is potentially giving up the upside potential of an active strategy for the assurance that the portfolio will achieve the intended desired return. As in the buy and hold strategy, by design the instruments best suited for this strategy are high-grade bonds with remote possibilities of default. In fact, the purest form of immunization would be to invest in a zero-coupon bond and match the maturity of the bond to the date on which the cash flow is expected to be needed. That eliminates any variability of return, positive or negative, associated with the reinvestment of cash flows. Duration of the average life of a bond, which is also its price sensitivity to changes interest rates, is commonly used in immunization. It's a much more accurate predictive measure of a bond's volatility than a bond's term to maturity. This strategy is commonly used in the institutional investment environment by insurance companies, pension funds, and banks to match the time horizon of the future liabilities with structured cash flows. It's one of the most sound strategies and can also be used successfully by individuals. For example, just like a pension fund would use an immunization to plan for cash flows, upon an individual's retirement, that same individual could build a dedicated portfolio for their own retirement plan. Immunization can be accomplished by cash flow matching, duration matching, convexity matching, and trading forwards, futures, and options on bonds. Similar strategies can be used to immunize other financial risks such as exchange rate risk. Often, investors and portfolio managers use hedging techniques to reduce specific risk. Hedging strategies are usually imperfect, but if a perfect hedging strategy is in place, it is technically an immunization strategy. Immunization examples: cash flow matching. Assume an investor needs to pay a $10,000 obligation in 5 years. To immunize against definite cash outflows, the investor can purchase a security that guarantees the 10,000 inflow in 5 years. A 5-year zero-coupon bond with a redemption value of 10,000 would be suitable. By purchasing this bond, the investor matches the expected inflow and outflow of cash, and any change in interest rates would not affect their ability to pay the obligation in 5 years. Duration matching. To immunize a bond portfolio using the duration method, an investor must match the portfolio's duration to the investment time horizon in question. If an investor has a $10,000 obligation in 5 years. Uh, there are a few ways in which they can use the duration matching. Purchase a zero coupon bond that matures in 5 years and equals $10,000. Purchase several coupon bonds that each have a 5-year duration and a total of $10,000. Purchase several coupon bonds that total $10,000 but have an average duration of 5 years when viewed together. Uh, it's possible to make a profit using duration matching. All that needs to be done is to construct a bond portfolio in a way that the portfolio's convexity is higher than the convexity of the liabilities. Choosing an immunization strategy. Portfolio immunization using duration and cash flow matching are two types of dedication strategies to safeguard the funding of liabilities when due. Immunization via duration matching aims to balance the opposing effects interest rates have on the price return and reinvestment return of a coupon bond. Multiple liability immunization strategy pays off better when the interest rate shifts are not too arbitrary. It requires a lower investment than cash flow matching but does carry reinvestment risk in the case of non-parallel rate shifts. Cash flow matching, one on the other hand, relies on the availability of securities with specific principals, coupons, and maturities to work efficiently. This is far-fetched in the most practical cases, and so this strategy requires more cash investment. It also runs the risk of excess cash balances accumulating and being reinvested at very low rates in between liabilities. Due to these factors, multiple liability immunization is generally superior to cash flow matching. Linear programming and optimization techniques are used to extend and even combine the two strategies in order to achieve even better results. Now we have advertisement. So compete risk-free with 100,000 in virtual cash. Put your trading skills to the test with our free stock simulator, complete with thousands of Investopedia traders, and trade your way to the top. Submit traders in a virtual environment before you start risking your own money. Practice trading strategies so that when you are ready to enter the real market, you have the practice in it. Try our stock simulator today. Okay, guys, it's all for today. Today we've spoken about immunization, its strategies, and it's all for now. See you in my next videos. Bye.